Assalamualaikum and salam sejahtera. This is topic 3, accounting equation and accounting classification. There are 4 subtopics here. The first one is statement of financial position. In short, we call it SOP format and its classification of items. Number 2, the purpose of SOP. Number 3, accounting equation itself. And number 4, effects of transaction on the accounting equation. At the end of this topic, you should be able to identify the components in the statement of financial position and to relate them with the accounting equation. Okay, before I proceed with the format of the statement of financial position, all right, so basically, the business transaction that you have incurred in the past can be classified into asset, owner's equity, liabilities, income, and expenses. As per definition of accounting, the first step, okay, in the definition of accounting is classifying. So meaning the business transaction are to be classified into asset, owner's equity, liabilities, income, and expenses. Okay, but then do we show all of this classification in the statement of financial position? The answer is no. Out of 5 classifications in accounting, only 3 classifications will be shown in the statement of financial position, while the other 2 will be shown in the statement of profit or loss and other comprehensive income. Classifications of items to be included in the statement of financial positions are asset, owner's equity, and liabilities, whereas income and expenses are to be shown in the statement of profit or loss and other comprehensive income. Okay, let's look at the format of the statement of financial position. In the format, it shows how we are going to disclose the items of asset, owner's equity, and liabilities. So this is the format, okay, for statement of financial position. All right. So we are going to start, okay, in our statement of financial position. Okay, we are going to start with asset. However, the asset need to be further divided into non-current asset and current asset. Non-current asset here, okay, other names for non-current asset is long-term asset. For current asset, short-term asset. Okay, so examples of non-current assets are land and buildings, fixtures and fittings, office equipment, machinery, motor vehicles. For current asset, we have inventory, account receivable, cash at bank, cash in hand, prepaid expenses, and accrued income. Alright, and then we have owner's equity. Okay, in the owner's equity, we are going to show the balance of capital, okay, which is the amount of fund contributed by the owner into the business. It could be cash or it could be other asset. Alright, this amount of capital will increase or decrease depending on the business performance, which is we are going to add if the company earned profit for the year, and we are going to minus if the company has any loss for the year. And then we are going to minus also any drawings. Okay, so drawings are referring to the personal transaction of the owner, but the owner, okay, was using the money or the asset of the business for their personal purpose. Okay, so any cost relate to the personal transaction of owner then will be minus or deducted from the owner's equity. Okay, next we are going to show the liabilities of the company, the financial obligations of the company. For the financial obligations, okay, or the liabilities, we are going to divide them into non-current liabilities and current liabilities, long-term liabilities and short-term liabilities. Okay, if the settlement of the financial obligation took more than 1 year, we are going to put them under non-current liabilities. If the financial obligation took less than 1 year to settle, then we are going to put them under current liabilities. Okay, all right. So let's look at the definition of each classification of items. What are assets? Asset can be defined as a present economic resource. Okay, so resource which are controlled by the entity, meaning that the entity has a control over the item due to the contracts, okay, and other ways of control as a result of past event, meaning that you have performed the business transaction, okay, to get the asset, okay, to buy the items and everything, and the items, okay, the items that you bought, okay, or you purchased or you acquired, in what way, all right, has the potential to produce the economic benefits, okay, has the potential to generate more monies in the future, okay, has the potential to reduce the cost in the future, meaning that it will bring you something good, all right. So any item that you have acquired as a result of the business transaction in the past, and it will bring future economic benefit, okay, then the item, okay, met the definition of asset. Okay, examples here, as you can see on the slide, we have buildings, we have inventory or stock, we have money, okay, it can be cash in hand or cash at bank, you have factory, you have furniture, okay, all right, next. Okay, so as you saw previously, in the format of statement of financial position, we have non-current asset and we have current asset. Okay, now you have all these items that you have acquired in the past, okay, these items, all right. So and this item now, okay, meet the definition of asset, so you can record them as asset. Okay, but which category of asset? Okay, which category of asset? Okay, so we have non-current asset and we have current asset. So let's look at the first one, non-current asset. Okay, non-current asset, okay, is an asset bought not for resale, but to be used in the business operation or to be used by the business administration and has estimated useful life of more than 1 year. Okay, simple example, when a business purchase a building, of course the building will be used more than 1 year. Therefore, the building will fall under the category of non-current asset. However, for non-current asset, it does not limit to something that you can see. Okay, if it is something that you can see, you can touch, you can feel, that one is called tangible non-current asset, something that has a physical substance, item that has a physical substance. All right, what if your asset has no physical substance, meaning that you have the rights, okay, to use the asset to generate more money in the future, but that asset cannot be seen, okay, touched or feel. Okay, so that would be an intangible non-current asset. What are the examples of intangible non-current asset? It could be patents, copyrights, or trademarks. Okay, we have incurred costs. We have paid money to get the patent, to get the copyright, to get the license. Okay, we have the contractual rights, okay, to use the trademark, to use the product, okay, and this, okay, will bring us more money, will generate more money to our business. All right, we have control over trademark, we have control over copyright. Okay, it belongs to us. Okay, it belongs to our business. All right, so that one also can be classified as asset under non-current asset. Okay, for intangible non-current asset. Okay, what if you have invested your money somewhere? Maybe you have purchased other companies or other business shares. Okay, or you have placed your money in the fixed deposit account. All right. So this also can be categorized as non-current asset. Okay, under investment. Okay, under investment. All right. Okay. Let's look at the next one. Okay, so in this slide, okay, I want you to fill up the table, okay, with the examples of tangible non-current asset, intangible non-current asset, and also investment. Okay, you may go back to the previous slide, okay, to get the examples, okay, from my explanation, or you may refer to the format of the statement of financial position, okay, to get an example for non-current asset and then to categorize them accordingly into tangible, intangible, and investment. Okay. What about current asset? Okay, current asset are either cash or items that can be converted into cash within 1 year. I'm sure all of you understand. Okay, cash, it could be cash in hand, it could be cash at bank. Okay, what about item that can be converted into cash within 1 year? What are the examples of item that can be converted into cash within 1 year? Okay, examples are number one, inventory. When you purchase an inventory, you hope that as a business owner, we usually hope that we can sell our stock or inventory very fast, possibly within the same day, the same week, the same month. Okay, and we hope everything can be settled within the same year. Okay, so that is examples of current asset that can be converted into cash within 1 year. Another example is account receivable or debtors account, penghutang. Okay, so account receivable is another example of current asset because okay, we hope that okay, when we give them, okay, when we sold them our inventory, we sold at credit, okay, we sold at hutang. We hope that okay, they can settle okay the debt within 1 year because a normal credit term, okay, a normal credit term usually takes 30 days, 60 days, 90 days, or as long as 120 days. They are usually within 1 year. Okay, so meaning that account receivable also is something that can be converted into cash within 1 year. That's why it falls under the category of current asset. Okay. So let's look at the next one. Right, owner's equity. Okay, what is an owner's equity? It is an owner supplied funds to the business or the amount of financing by the owner. Okay, it represents okay, the capital contributed by the owner. The capital can be in the form of cash, it can be in the form of other assets. For example, you contribute motor vehicle to your business, you contribute your building to the business, okay? Because of the separation between the owner and the business, so we have to record, okay, every details of the owner's contribution so that we want to show to the owner so that the owner knows that okay, this is my equity, this is my wealth, okay, from the business. Okay, the amount of equity, okay, the amount of capital contributed by the owner can be increased or decreased due to profit or loss. It will increase if the business earn the profit and it will decrease if the business suffer the loss. And there is also a decrease to the owner's equity because of the drawings made by the owner. Okay, what does it mean by drawings? Okay, drawings is the amount of cash or asset took by the owner for personal use. The owner took the business money. The owner took the business asset. It can be inventory, it can be other asset, okay, for the personal use. If the owner used them for personal use, then we are going to minus, okay, from the owner's equity. Okay, they are called drawings. All right. This is because of the business entity concept, where we have to separate between the owner and also the business. They are assumed as two different entities. Okay, so I hope you understand that part. All right, so how do we calculate profit or loss? Okay, the profit or loss is calculated by deducting expenses from the income. Income minus expenses equal to profit or loss. If income more than expenses, you get the profit. If expenses more than the income, then you get the loss. Alright? Okay, so the next one in the statement of financial positions is the liabilities. So liabilities are basically funds supplied by external parties to the business. There are two types of liabilities, non-current liabilities and current liabilities, similar to the asset, where we classify them into long-term and short-term. Long-term liabilities and short-term liabilities. Another explanation for the liabilities is the financial obligation of the business. Okay, financial obligation to be settled, okay, by the business within a certain period. If that period is more than 1 year, we are going to put that item under non-current liability. If you can settle the debt within 1 year, then it will be classified under current liability. Non-current liability are, for example, long-term loan, okay, long-term bank loan, all right, mortgage, which took more than 1 year to settle. Okay, current liabilities are, for example, account payable or account permutang, right? Account payable, because we purchase something on credit, okay, from the supplier. All right, so we are going to pay the supplier within the normal credit term, which could be 30 days, 60 days, 90 days, or 120 days, which is still within 1 year. Okay, and then we may have bank overdraft, where you take the money more than the account balance, okay, if it is allowed by the bank. Okay, that one also will be classified as current liabilities, because one day you are going to settle the difference with the bank. Okay, how do we know the preparation of our statement of financial position is correct? Have you ever heard of balance statement of financial position? Oh, balance, said the accounting student. They are so happy when they get a balanced statement of financial position, or this balanced balance sheet. All right. So what does it mean by balance? Okay, in the statement of financial position. All right. Balance here meaning that, okay, they get an equal amount of asset, okay, to equity and liability. Asset equal to equity and liability. Okay. So if you get an equal amount of asset and equity plus liability, it means that, okay, it is possible that, okay, your preparation of statement of financial position is correct. Okay, if you did not get a balanced amount, okay, or if the amount is unequal between the asset and equity plus liability, okay, there must be something wrong with our statement. Okay, all right, so in this basic accounting equation, okay, so we have three classification of items: asset, equity, and liability. So this is how we arrange in the accounting equation: asset equal to equity plus liability. Even when you prepare the statement of financial position, okay, you first show the asset, okay, non-current asset plus current asset, and then you get total asset. And then you're going to present another part, which is equity and liability, non-current liability and current liability. And then you are going to calculate the total equity and liability. Okay, so these two amounts should be equal for you to get a balanced statement of financial position. If it is not balanced, there must be something wrong with your account. Okay, so another implication, okay, from this basic accounting equation is that, okay, um, it means that, okay, when we record the transaction, okay, when we record the transaction, we must make sure that, okay, from the transaction, okay, the equation would remain balanced. Okay, if one side increase, the other side also increase, or, okay, or there will be an increase or decrease in one side only. Okay, and the equation would remain unchanged. Okay, all right. So let's say, for example, here, um, the business purchased a motor vehicle, okay, using cash money. Okay, so motor vehicle is to be recorded as asset. Cash money also is an asset. So motor vehicle will increase, okay, meaning the asset will increase. At the same time, there is a decrease in asset account, which is cash. Okay, so the equation remain unchanged. It remain balanced. Okay, all right. So the basic accounting equation, okay, will guide you, okay, on the preparation and the recording process in accounting. Okay, so so here, the rules, okay, so we have here double entry rules. Okay, so any increase in asset you have to debit, okay, any decrease you credit, any increase in equity and liability you credit, any decrease in equity and liability you debit. Okay, so the process of debiting and crediting the accounts, okay, because in accounting, the term debit and credit, for some, they tend to get confused, but in accounting, okay, the rules to record is either to debit or to credit. So what is the guideline, okay, that help us decide to debit or credit? Okay, it comes from the basic accounting equation. It comes from the basic accounting equation. Okay, so if you want to record an increase in asset, you debit, and then if there is a decrease in asset, you credit. For equity and liability, any increase you credit, any decrease you debit. Okay, so you will have a balanced equation. Okay, your equation remain unchanged. All right. Okay, next. Okay, so this is three examples on the transaction, okay, to show how it's going to affect the basic accounting equation. Okay, so basic accounting equations are asset equal to liability plus owner equity. All right. Okay, so let's say, for example, you started business with 35,000 cash. You, as the owner, okay, brought cash 35,000 ringgit into the business. Now, your business, okay, you have to always remember that the owner and the business are two separate entity. Okay, are two separate entity. Okay, all right. So now, the owner, okay, brought cash into the business. So what happened to the business? Business received cash. Okay, business received cash 35,000 ringgit. At the same time, okay, business has to record the contribution by the owner. So the contribution by the owner falls under the category of equity. Okay. So let me draw something, okay, to help you imagine the process, okay, the transaction. Okay, so let's assume this is the owner. Okay, and then this is the business. Okay, so now the business has nothing. Okay, asset 0, liability 0, equity 0. Okay, but then you, as the owner of the business, okay, you have registered your business, so now you have a business. All right, so now to start the business, you need to bring cash into the business. Okay, so you brought cash into the business of RM 35,000 ringgit. You brought cash into the business. All right. So now your business, okay, so what happened after that? Okay, so this is the first step. You brought cash into the business. Okay, so what happened after that? Okay, so what happened after that? Your business needs to record the amount of money received as cash. Okay, so the business is going to record that money received as cash, RM 35,000 ringgit. Okay, so cash, as I explained before, falls under the category of asset. Okay, so now, okay, this is for the business, yeah. This accounting equation apply to the business. All right, so what happened to the asset of the business? All right, so now the business has cash RM 35,000 ringgit. Okay, if we record only on one side, okay, we are not going to have a balanced accounting equation. Okay, so we need to record on the other side as well. Okay, so what is on the other side? Who contribute the money? Where the money comes from? Okay, we have to record the contribution by the owner of the business. So number 3, okay, so the other record is capital. Okay, so we have to record this one as well. Okay, all right, so that's why, okay, capital under which category? Owner's equity. So capital 35,000. So you can see that on the left hand side you have cash 35,000 ringgit, and then on right hand side you have capital 35,000 ringgit. What happened to your what happened now to your accounting equation? Now you have a balanced accounting equation. The business receive money, the business at the same time they have to record the money comes from, okay, comes from the owner under owner's equity. Okay, all right, so let's look at the next one. Okay, so we are going to look at this transaction individually. Okay, and the next one, the business acquired a bank loan worth 50,000 ringgit. Okay, the business acquired a bank loan worth 50,000 ringgit. Okay, so what happened here? Okay, so what happened here? So business, okay, so this is the bank. Okay, give money to the business. Okay, RM 50,000 ringgit. Okay, so the bank gave money to the business. Okay, so what does the business have in hand right now? So they have cash. So they have to record this cash at bank. Okay, so they are going to prepare, in short, we may record as bank, okay, or you may record as cash at bank. Okay, so to make it shorter, we are going to record only bank. Okay, so bank, now you receive RM 50,000. Okay, all right, so increase in asset because cash at bank is an asset. So now business asset increased by 50,000 ringgit. Okay, but if there is no record at all, okay, on the other side or on the same side, okay, no decrease on the same side or increase on the other side, so what happened? Your accounting equation is not balanced. Okay, so now to make it balanced, we have to show, okay, where does this 50,000 ringgit comes from? It comes from the bank loan, or in short, loan. So we have to record that. Okay, so from where this RM 50,000 ringgit comes from? From the loan. So we're going to record loan. Okay, loan under which category? Like I explained previously, loan is under liabilities. Okay, so liabilities. Right, so loan. See, you add here 50,000 and you add on the other side 50,000. Asset increase, liability increase. What happened to accounting equation? Balance accounting equation. Alright? Okay, so let's look at the last one. Okay, the business paid, okay, So the business paid the bank loan amounting to RM 50,000 by check. Okay, so after a while, okay, the business need to repay the amount of money that they owe from the bank. Okay, so they need to pay RM 5,000 ringgit, and they are paying by check. Okay, all right. So what happened to your cash at bank? What happened to your asset? Your asset will reduce by 5,000. So your asset will reduce by 5,000. Okay. And then what happened to your loan account? What happened? What happened to your loan account? Is it remain unchanged? Or will it increase or decrease because of this transaction? Okay, once you made a payment, then you have to show a decrease in the loan because you want to show that, okay, we have paid the money, right? We have paid the money. So now the amount that we owe, okay, is reduced by 5,000. So we are going to minus from the same account, loan account, okay, which is under liability. We are going to minus 5,000. We are going to minus from our bank 5,000. So when we talk about the effect, okay, if we ask you questions, so what is the effect to the accounting equation? Asset decrease, at the same time liability decrease. Okay, when we ask you about the effect, you have to talk about the asset, liabilities, and owner equity. You have to talk about this classification. Okay, so let's look at again transaction number 1. Started business with 35,000 cash. Okay, so what is the effect, okay, of this business transaction to the accounting classification? What happened to the asset? Okay, asset increase. Anything happened to the liability? No, but there is an increase also in equity. Okay, number 2. Right. Okay, you receive money. So what happened to your asset? Increase. Okay, where does this money come from? Okay, from the bank loan. Okay, bank loan under which category? Liability. Alright, so what happened? Asset increase, liability increase. Okay, the business paid the bank loan amounting to 5,000 by check. Okay, so you take out your money to pay the loan. Alright, so what happened to your money? Reduce. Money under which category? Asset. So asset decrease. Okay, so whose money that you pay just now? Oh, bank. Alright, so we are going to reduce bank account. Alright, bank loan account. Bank loan account under which category? Liability. So what happened to your liability? Your liability decrease. Okay, so these are the effect, okay, of transaction on the accounting equation. From the accounting equation that we have discussed previously, okay, other than discussing on the accounting equation itself, which is asset equal to equity plus liability, I also discuss, okay, about the journal entry, okay, about the process of recording, okay, which is debit and credit. Okay, so here I'm showing you an example. Okay, when we talk about, okay, when we talk about the journal entry, we have to state clearly, okay, which account to be debited and which account to be credited. All right, okay, unlike when we talk about effect, when we talk about effect, we focus on the classification of items which are asset, equity, and liability. Okay, but when we talk about the journal entry, okay, which is to debit and credit, okay, we have to be very specific. Okay, specific meaning if it is an asset, okay, what type of asset? Cash. All right, so cash. Under equity, okay, what account to be recorded under equity? Capital. All right, so we are going to record as capital. Okay, all right, so let's continue our discussion, okay, from the previous example. All right, so started business with 35,000 ringgit cash. So we have discussed previously, okay, from this transaction, It will increase our asset and increase our equity. Okay, so what happened when the asset increase? Okay, so what happened when asset increase? So when asset increase, you are going to debit cash account. You are going to debit asset. Okay, what asset account? Cash account. Okay, and to record increase in equity, we are going to credit. Okay, credit equity. What equity account? Capital. So debit cash 35,000 ringgit, credit capital 35,000 ringgit. Okay, let's look at the next one. The business acquired a bank loan worth 50,000 ringgit. Acquired a bank loan meaning that the business asked for a bank loan, okay, it is approved and they get 50,000 ringgit. So there is an increase in asset. At the same time, there is an increase in liability, increase in their financial obligation because they have to repay the amount, okay, they have to settle the amount, okay, in a period uh, agreed by the bank, okay. All right, so increase in asset, okay, we are going to debit. All right, so we are going to debit. What account to debit? What account affected from the bank loan? Okay, when you get a money from the bank loan, usually it will be transferred to your bank account. So debit bank 50,000 ringgit. Okay, cash at bank 50,000 ringgit. And to record increase in liability, we are going to credit. So what account to be credited? Credit loan 50,000 ringgit. Okay. If you are not sure, then you can always go back to the previous slide, okay, to look at the accounting equation, to look at the basic accounting equation, which I already show you, okay, which account to be, if okay, there is an increase in asset, if there is a decrease in asset, equity and liability, should you debit or credit? Okay, so please go back to that slide again. All right, and then look at, okay, what to do with the accounts that relate to the asset, to the classification of items. Okay, all right, so the last one, the business paid the bank loan amounting to 5,000 by check. So we have discussed previously. Okay, so what is the effect to the business, to the accounting equation? Okay, effect is decrease in asset because we have to take out our money. Okay, and then decrease in liability because we have reduced our financial obligation. Okay, all right. So how to record this one? Okay, which account to be debited, which account to be credited? Okay, if there is a decrease in asset, what should we do? We should credit. Okay, what account to credit? Okay, so we pay by check, meaning that we are using money in the bank. So credit bank account 5,000. Okay, decrease in liability. What to do decrease in liability? Go back to the slide. Okay, look at again. Okay, what is the guideline? Okay, to record the decrease in liability. So decrease in liability, you debit. What account to debit? Bank loan account or loan account. How much? 5,000. Okay, so other than knowing the effect to the accounting equation, okay, other than knowing the effect of the business transaction to the accounting equation, which is to identify which classification of items increase, okay, or decrease, you need to know also which account to debit and which account to credit. All right. Okay, so should you have any question, please ask in the comment. Okay, so and then I will try my best to answer every question. Okay, so that's all for topic 3. Okay, and thank you.